Hello traders, Gary Wagner here, just about 10 o'clock in Honolulu, 4 o'clock in New York. It is Thursday, last day of the month, March 31st, 2016, also last day of the first quarter of 2016. And on that last day, we do have gold staging a moderate recovery after yesterday's double-digit sell-off. We do have gold back up over 1230, 1231 and change, puts it up about $6 or $7 on the day. Now the low was 1223. Of course, we are long from 1238 with stops below 1217. So we weren't threatened with our stops at all. And in terms of the high around 1240 on the day. Significant is the fact that the dollar continues to trade under pressure to lower pricing. Time permitting, we'll take a look at a dollar chart on today's video report. So traders, as of about 10 minutes after 10 in Honolulu, 10 after 4 in New York, of course, we do have gold holding steady, holding up about $5, $6 on the day, trading to a high of about 1239.50, and that, of course, is basis the COMEX contract. We are looking at a half-a-day chart. Half-a-day chart is in standard candlestick format, and in this chart, we're going to attempt to look at some different models to try to forecast where we think this particular market could in fact go. And we're going to create our forecast utilizing the 3 Elliott Wave golden rules. One of those golden rules simply states that Wave 3, the impulse wave 3, cannot be the smallest of any of the other impulse, meaning either wave 1 or wave 5. Simply put, wave 3 is typically the largest, but the actual rule is it cannot be the smallest. Now, with that in mind, what we can then do is then simply do a fib extension for this entire move that we saw in this subcount wave 1, or behind the subcount, wave 1, to forecast where in fact we think we could see gold head to. I have put in our fib extension. Now, there is a caveat to this forecast model, and the caveat is not to expect this move overnight. This is part of a large major B, which I believe is a multi-year move, and I believe that each of these moves that we're looking at, you're talking about anywhere between 3 months and at least a quarter of a year. As you know, we've just finished our first quarter this year. You can see that this first rally, which really began about the middle of last year. This is December, of course, right here of 2015, December 16th. So really began, call it middle of December last year, and culminated almost at the middle of March this year. So you're looking at a pretty long protracted move in the market. Now, that being said, we had this short retracement. If in fact this correction is over and we go into an extended wave 3, now that extended wave 3 is going to take us at minimum to 1445, and that would be based upon a simple calculation saying that wave 1 and wave 3 are roughly the same length and time. As you can see, this is a 100% extension. A 61% extension would take us to 1353, so that's going to be an important number also. And again, I'm looking at this as something that would conclude towards the third quarter, maybe even the last quarter of 2016. Within that timeline, I promise you, we will see many peaks and many valleys, but I wanted you to have an indication of what we are looking at in terms of potential over this next year. This has been Gary Wagner, wishing you, as always, good trading. Maintain your current long position in gold. Maintain your current stop. We'll talk to you tomorrow for the weekly wrap-up and review. Bye-bye.